Thanks for joining us today on Market Call. I'm Morella Fernandez. Javed Mirza with us on the show. He's quantitative technical strategist at Raymond James. He'll take your questions on technical analysis today. Here's how to reach us. You can call 1-855-326-6266. You can email your questions in as well. marketcall@bnnbloomberg.ca. Jav, good to see you.
Thanks for
coming in. The TSX had a bunch of record closes so far in January, fairly good streak. You're saying it's evidence that we're moving into a different cycle of the market. Can you explain?
Yeah, so I think if you recall last time we were here chatting with you, we were very constructive on Canada, and we thought we were going to come into the phase of the market which we call the boring middle. And that's where you see an expansion of the breadth. You see money flowing into small caps and broadly into other areas of the market. So we've seen Mag 7 leadership in the US, and now we're seeing a rotation away from some of those names and into other areas of the market. So this, we think, should last some time into 2027. So we're quite constructive on equity markets broadly and very bullish on Canada.
Okay. You mentioned, or we talked about the record TS high closes. What else are you seeing to support that idea that we're moving into that cycle?
Yeah, great question. So what I would highlight is we're seeing small caps in the US, such as the Russell 2000, break out to new all-time price highs. And what's interesting in Dow Jones Industrials, Dow Jones Transports, they're confirming that as well. But what is quite noteworthy is the NASDAQ, up until now, has not broken above its November highs. And so that is telling us that we're seeing that as a source of funds, and people are selling some of those, or portfolio managers are selling some of those Mag 7 names. So this is a great chart. I'm just going to draw it on here if you don't mind.
Sure.
But basically, we've got that high here in November, and we haven't broken above it. But if we could get the TSX on here, and what I would highlight here is
coming in just a second.
Yeah, no worries.
Is that more, you would have more growth at the start of the year for the TSX than you have had with the NASDAQ?
Exactly. And we're seeing the same thing with the Russell 2000. So I don't know if we can pull up IWM. It's an ETF in the US, or we've got the TSX here. And so that really shows us here is that the TSX is breaking out to new highs. And if we look at the S&P 500, it has done the same thing. So all of this broadly is positive. And what we could potentially see this year is we're forecasting for a pretty decent year for the U.S., so low double digits. But what we could see potentially, this is the second year of the presidential cycle, which is typically the worst year. And I'll draw on the screen what typically happens. So from, call it January to October, we have some seasonal weakness. And what that is you have the midterms here in October, November. And so there's a lot of uncertainty because the market is unsure what the president is actually going to be able to get through in terms of legislation. And so this is the S&P 500, just to be clear. And then what you see in November and December is once that uncertainty is gone, then markets get a better feel for what the president can or cannot enact, and then they start running. So typically, third year of the presidential cycle sees a return of around 3%. We're forecasting, call it 15%. So if you take in between there, call it like 8 to 11%, that's generally where I think the market could go. But what I want to highlight is you could see the mega cap names up maybe 5 to 10%. But because they're such a large portion of the index, you could actually see a lot of names up 15 to 20%, right? And so if you aggregate the index is up maybe, call it 8 to 10%. The bigger cap names are up maybe 5 or 6%, but the rest of the money is going to go to other areas of the market. And I think that is going to be quite bullish for a lot of other areas of the market.
Okay, let's take a quick break. We'll line up the phone calls and the emails for Javed Mirza, quantitative technical strategist Raymond James. Back in a moment. Welcome back. We're going to start right now with an email from Jay. He says, I would like to get your opinion on Bombardier for a long-term hold. I've already enjoyed a good run. I don't want to get greedy. I've skimmed some profits, and Bombardier still makes up about 6% of my TFSA portfolio. So a couple of things to look at here. First of all, would you continue to hold Bombardier? Would you continue to trim if it continues its trend moving up?
Yeah, so great question. Great call here by Jay on Bombardier. We like it. So remember we talked about where we are in the market cycle model. So we split the market cycle model. It's essentially the business cycle into 5 different phases. So phases 4 and 5, those are the contraction phases. That's when you see the stock market typically coming under pressure. Phases 1, 2, and 3, those are the expansion phases. They typically last a year. And what we believe last year was phase 1. And so this is phase 2. So the reason this matters is because industrials typically do well in phase 2. So the chart looks great. I think if we went back to the previous chart in Bombardier, I think there was a level, call it around 240, that I would highlight. So the bottom line is I would continue to hold. And then if it takes out one of these recent levels here, perfect, this is the chart. So around this 240 level, you can see there's pretty good support. So what you could do is you could trim, if it goes up another percent, you could trim 1%. And then alternatively, once it breaks this uptrend, that's when I'd start trimming more in size. And I think a move below that 240 level would be the first sign that something significant was happening.
Looked at the percentage and went, wow, okay, 200% in 1 year, just about. So
it's and we're seeing this in a lot of other industrial names, Finning, Toromont. So we're bullish on industrials broadly. Exchange Income Fund, that's covered by our analyst Steve Hansen, and he continues to like that name. A lot of stuff with Arctic North, but bottom line is we like industrials here.
Okay, let's go to our first caller on the line. Then Tyler is in Toronto. Hi, Tyler.
Hi, Marilla. Hi, Javed. Thanks for taking my call. One thing no one seems to be talking about right now are real estate. What kind of the board of real estate seems to be popping? I'm looking at ZRE, the equal weight ETF for real estate in Canada, and we've hit all-time highs. So I was wondering if there's something I'm missing, some reason that real estate is not really being spoken about too much. So I want to add a few comments about real estate and how does ZRE look right now. Thanks.
Okay, can you tell me a little bit about ZRE?
Yeah, so I don't know too much about it.
Sure.
I'm assuming it's like, I think, was it ZEB? That's the BMO Equal Weight Banks Index. What I would highlight, great question by Tyler. I like where he's looking. And the reason is we think rates are actually going to be in a choppy sideways trading range, which should remove a headwind for REITs. They've been a big underperformer. And our REITs analyst, Brad Sturgis, he just came out with his outlook for this year, and he's bullish on the space. I like the space a lot too. Nobody really is interested in REITs or is talking about them. And ultimately, we think we're headed into an area where inflation is going to be more persistent, and REITs actually do pretty well in terms of protecting your portfolio against inflation. We're cautious on bonds longer term, so I think this is another area of the market to put money to work for those people looking for dividend income. I really like the setup here. We're seeing a lot of Canadian REITs and US REITs turn up. And in our outlook, one of our best ideas was Granite, the industrial REIT, and Brad actually likes Dream Industrial. So really like the setup here on REITs. I think it's timely, and they should, in our view, where we see things headed, work into 2027.
Okay, let's move on to our next caller. Then Frank is on the line. He is in Toronto. Hi, Frank.
Hi, Marilla. Hi, Javed. Thank you for taking my call. My question is regarding Honeywell. I recently purchased it, and can you give me his technical analysis on this? It looks like it's due for an outbreak. Thanks very much.
Okay,
Bye.
Thank you for the question. Honeywell, I believe, is splitting up, right? So what do you see when you look at this chart? And then, the timeline, I'm not sure about the timeline for the split.
Yeah, so that I don't know offhand either. So what I would do is I agree with Frank. So we've had this bigger term downtrend. We've broken out. It looks pretty positive here. So next shorter term target over the next couple of months is going to be around that 240 level. So call it 10% upside from current levels. If we can pull up maybe a 3 or 5 year chart, then I can give a better idea of the longer term outlook here. But perfect, thanks. Yeah, so here is this bigger uptrend, and then we saw that bigger downtrend break, and now we're seeing like we're pushing up again. So here's that 240 level we were talking about previously. So if we can push above that, next upside target should be, call it around 260. So I like the setup here. I think it was a great entry point by Frank if you bought it recently. And the trend is up here, at least in the intermediate term, so we like it.
Okay, let's take a quick break. Then we will be back with Javed, quantitative technical strategist, Raymond James. Again, he's taking your questions for technical analysis. We're back in a moment. Welcome back to Market Call. We are going to another email right now from Richard. He says, could I get your guest's opinion on Lithium Americas for a position in the stock? We'll pull up that chart in just a moment. There it is at 827 today. Obviously, it had a big takeoff in October.
Yeah.
But what else do you see when you're looking at this?
Yeah, so here's the big run up, and then here's a pullback. Here's a sideways consolidation. We've broken out to new highs here in the intermediate term, so this looks positive. Very likely we're going to retest or attempt to retest these highs around 12. And then if we get a longer term chart, I could give a better outlook. Or if we can pull up LIT or REMX, those are rare earth metals ETFs. Okay. Yeah, so it's definitely telling us that something here is changing after this bigger run up here. So it does look positive. I think 15 or 12 was that previous level that I highlighted. But if we can pull up LIT or REMX, those are just ETFs. And what they do is they aggregate a variety of these rare earth metal plays. And what it's telling us is that, given what we're seeing globally, especially everything with geopolitics, is we're seeing signs that companies and countries are in this kind of race for resources. So if you know history pretty well, you recall that back at the start of the 19th century, there was the race for colonies, where you had the imperial powers racing for colonies across the world. And so we're seeing the same thing here. Yeah. So
they're having some trouble. They're having some trouble pulling up REMX. Which is in the U.S. and is at about $95 U.S. right now.
Yeah.
But for something like rare earths or lithium plays, is it better to go ETF as opposed to straight stock?
Yeah, so I think you want to play the broader theme. So unless you have, high conviction or a lot of information on a stock, it just opens you up to stock-specific risk. And so we think there is this broader rare earth metals theme and lithium theme, so that's a better way to play it, where you don't get adversely affected by something negatively impacting the one stock you hold while the rest of the space continues to run. So for people who are more generalists and just kind of dabbling in the space, I typically try to recommend the ETF.
Okay, let's go to our next caller then. Henry's on the line. He's in Vaughan, Ontario. Hi, Henry.
Good morning. Thanks for taking my call. I'm calling about MPLX. A midstream oil and gas producer. Are we at the beginning of an oil and gas bull market? Thank you very much.
Okay, so differing opinions on where we are with oil since the price has been down so much and then Venezuela happened. When you look at MPLX out of the U.S., there it is right now, what do you see?
So we like the setup. And that's kind of a little hint, because when we talk to our best ideas that we're going to talk about later, we actually have a pipeline in there. So maybe if we can look at a 3 to 5 year chart, I can kind of highlight what we think is going on in the space. But generally speaking, remember we talked about those phases of the market. So we think we're in phase 2. So phase 3 is typically when energy does best. And that's because if you think about it, what's going on is the economy is running on all cylinders and companies need to get their widgets to the consumer. But in order to do that, they need fuel to get
transportation. Okay.
Exactly, transportation. So what we're seeing here is a lot of these names have been in these sideways consolidations, and now they're trying to break out to the upside. So I like the setup here. I like this chart. The only thing I'm a little bit concerned about is for average viewers. I think this might be an LP. I know there's a special tax treatment in the U.S. for some of these pipelines. So that's my only concern, but I like this chart. And I do think as we get towards the end of this year and into next year, I think energy is going to pick up. We love the commitment of trader data that comes out every Friday from the Chicago Board of Trade. You can just go to the website and Google it. And what it does is it tells you the positioning of commercial hedgers. Those are the producers, and they typically have the most information. And then you have large traders. Those are lawyers and dentists. And then you have small traders are lawyers and dentists, and large traders, those are hedge funds.
The institutions.
Yeah, the institutional hedge funds. And right now, commercial hedgers are very long crude oil. And so they always hedge, but they're the least hedged that they normally are. So what that's telling us is smart money thinks the price of crude oil is going to go higher over the next, call it 6 to 9 months. So I like energy stocks here. They've been kind of basing. A lot of the Canadian stocks have already pushed higher. And I think as we get into the end of this year, early next year, energy is going to be a big theme.
Okay, let's get to one more caller before the break. Rhonda's on the line. She's in Aldergrove, BC. Hi, Rhonda.
Oh, hey, good morning. My question is on Gatekeeper Systems. I love the idea of it, and it had a great little run up there, and now it's sort of doing the slow bleed. And so just your thoughts and ideas on that chart. And also, do you have any advice for people to be disciplined on the stop loss? How do you do that? Thank you.
Thank you for the question. Tell me about Gatekeepers.
Yeah, so actually I don't know.
Okay, let me see if I can find some information.
Yeah, I can take a look at the technicals and they'll tell us the bigger story. So we've had this bigger run up and then there's some sort of negative news or some consolidation event here. So as long as we hold in where we are now, call it around this 175 level, then as long as we can hold the floor here. But my concern is we break below the support level and then we come back all the way to call it this 125 level. So in terms of, Rhonda, your question is great. That's the toughest part of this business in what we do. It's easy to give out a bunch of buy recommendations, but there's lots of books written about buying stocks. There's very few books written about selling stocks. That's the toughest part of the game. So the way I do it personally is normally I try to scale out. And that way, if it does reverse, I can add back in. But if it does continue to head lower, then what that does is it basically you've got a lower position in the stock and you can continue to reduce. And one thing, I had a friend at a previous role and he told me something which I always remembered, which was quite wise, is every stock that's down 90 or 80% started off down 10%. So that's why it's usually 10% is where I like to start trimming it. And then after that, as it continues to go lower, the market is telling you something. We have our own opinions, but it's always best to listen to the market.
That piece of advice just made me go, ooh, right? Which
Yeah.
I'm sure a lot of people are doing. Just for the note, Gatekeeper Systems, they do intelligent video solutions, so transportation links for smart cities, I guess. So perhaps real-time video of what's going on in transportation. Okay, we're going to take a quick break. We will be back with a look at Javed's past picks. That's coming up next. All right, time to go through Javed's past picks from January 31st of last year, so just under a year ago. At the time, he chose Imperial Oil, IMO, on the TSX at 96.67. It is up to 137.03 today, so 42% upside and 45% upside when you include total return. We talked about oil prices being down, but Imperial Oil has clearly done very well. Is it a stock you still hold, and why do you think it's done well when some of the other oil stocks have not? Yeah,
so I like it. Talking to our fundamental analyst team, I think it's one of the lowest cost producers. And at that point, we were a little bit cautious on the market because if you recall back in 2025 at the start of the year, we thought this 4-year cycle reset, essentially the contraction phase of the business cycle, was going to occur sometime in 2025. I think that's what happened from February to April. You had a lot of price damage. It was very short, but that's why the picks you'll see are a bit more on the defensive / stable side. So I still like IMO here. Like we're testing around this 140 level. If we're correct that we think energy is going to be a play into the back half of the year and in 2027, I don't mind adding exposure here. This looks compelling. The longer term trend is up. I'm bullish Canada, so I think if you're going to look at oil stocks, it's definitely one of the ones I'd be looking at. Okay, let's go to your next past pick, Waste Connections, WCN on the TSX, so 267.05 at the time, so just under a year ago.
230.78 today, 14% drop, 13% total return drop. What's happened with Waste Connections, and have you held a position in it or have you trimmed?
Yeah, so just, whenever we do these recommendations, we don't own it or personally or in the funds. That's why we don't hold many stocks in the TSX or S&P 500 so that we can be totally clear and transparent with clients. But if we pull up a longer term chart, maybe over the last 3 or 5 years, what I wanted to flag here is the same rationale is these businesses are awesome. Sorry, this is Waste Connections, ticker WCN.
This is the Agnico we have, which is coming up next. We want to show Waste Connection, WCN, if we can. And you wanted a 3-year?
Yeah.
Okay.
I just want to highlight the longer term trend. So we highlighted here. Technically, it looked positive. I wouldn't have changed anything, based on the way the chart looked at that point in time. We have had this bigger pullback. Ultimately, these are great companies, boring businesses. This is what you want to own. You want the bulk of your portfolio to be in these boring businesses, and then maybe call it 5 to 10% in exciting names that you can talk about at cocktail parties. But what I would highlight here is ultimately longer term. I would view this pullback here as an opportunity to add exposure to one of the best companies here in Canada in terms of stability. You're always going to need to pick up waste. And especially with the growth in Canada, and I talked about my trip here from the GO station and all the construction, and you're always going to need a business like this. So longer term, maybe we can pull up a 10 or 15-year chart, and I just want to show people on Waste Connections what that longer term chart looks like.
Okay, we'll pull that up in just a second, and then we will move on to your third pass pick. You said Waste Connections last year. You thought we were in a certain part of the cycle, but it was a short cycle.
Yeah, we were looking for more defensive stocks, and so the stock has come under pressure, which makes sense. We're in a bullish phase of the market, a new 4-year cycle. So portfolio managers are selling some of the more defensive areas of the market and adding cyclical or offensive exposure. But if you look at this long-term chart, this really highlights that I think this is going to be a great longer-term entry point here near these levels.
Okay, let's get to your last pass pick from January 31st last year. Agnico Eagle mined AEM 135.08. And with the run that gold has had, which has been pretty incredible, it's at 294.18 today. So 117% upside there, and 131% over the last year. Agnico clearly has done very well. So have the other gold stocks and ETFs. Is this something you'd hold on to for 2026?
Yeah, and we can talk about this later. I think if we can pull up a longer term chart, I can kind of walk through the thesis. Is we are seeing at the margin this kind of race for resources. And the reason we highlighted it here is because we're looking for a little bit of a defensive exposure, and we saw that gold stocks were on the move. Obviously didn't anticipate anything quite like the return we're seeing here. But what we're seeing globally is a little bit of anarchy and a movement away from law and order. So this is typically when gold does pretty well. I think Canada is positioned so well. If we can just stay neutral and remain a country of law and order, people are going to come and want to invest here because they know there's stability and we have so many natural resources and it's just such an awesome country. And so what I would highlight is we're seeing the gold stocks on the move again today. And one of the funniest comments I read online is that gold is like the VIX for U.S. international relationships. So basically, as U.S. international relationships continue to deteriorate, you're seeing people continue to pile into gold. I think there's a bigger story behind this, a move away from fiat currencies toward hard assets. We're seeing central banks in Russia and China buying gold. And ultimately, something we'll probably talk about later in the segment is we're seeing this longer term shift away from paper assets and toward hard assets. And that's going to impact everybody who's watching the show, and especially everyone in Canada. Because if this trend continues, then what's going to happen is global money managers are going to start shifting money towards those areas and markets that are beneficiaries or have a lot of natural resources. And Canada is going to be one of the top picks. So we saw that from 2000 to 2010. The TSX continues to do pretty well, so I'm very bullish on Canada.
Okay, let's take a quick break. We'll be back with more of your phone calls for Javed in just a moment. Stay tuned.
Exactly.
Welcome back. Let's go to Rick online. He's in Wainwright, Alberta. He's got a question today. Hi, Rick.
Hi, how are you?
Good, thanks.
I'd like to ask about Exchange Income Fund. It's done quite well the last year, and I'm wondering how the guest feels about how it looks. Thank you.
Okay, we did touch a little bit on it earlier in the show, but let's look at the chart for Exchange Income.
Yeah, so this continues to work. It's covered fundamentally by our analyst, Steve Hansen. He likes it. I like it. The technicals look good. It is a little bit extended here, but I think they do a lot of unique things, especially doing Arctic surveillance and a lot of the surveillance in the ocean here for Canada. So I think it's got more upside. Technically looks good. And the thing that from our side is the most compelling is it's in that industrials wheelhouse. So phase two, typically technology, industrials, and basic materials. Those are the leadership areas. And so Exchange Income Fund really sits right in that sweet spot. Chart looks awesome. We like it.
Okay, so Exchange Income, can you remind us about a little bit about what they do? Because as you mentioned, they do the surveillance, but they're kind of a holding company, aren't they?
Yeah, and so there's a lot of different businesses, and that's why I think it's been tough to value. Now, that would be something our fundamental analysts would have a lot more insight into. So I don't want to, give viewers misleading information. But from everything that they do, there's a lot of transportation, like you said, the holding company. So, but they're in that sweet spot in the market cycle model. Technicals look good. So that's, from our perspective, it checks a lot of boxes.
Okay, let's go to our next caller then. Shondell is on the line in Halifax with a question. Hi, Shondell. Are we connecting with Shondell? She's still there?
Yeah, I can hear you.
Oh, there you go. Hi, how are you?
I'm good.
What's your question?
Is there more upside for OGC.TO? There's been a lot of profits coming in, but I tend to get a little confused when to sell.
Okay. This comes along the lines of the earlier conversation.
Yeah.
When do you sell and when is a good time? You gave some broader advice on what you do and how you look at it. But if we can pull up this chart, we can kind of get an idea of what he is dealing with. Give us your rule of thumb again.
Yeah, so I think, depending on the allocation the caller has in their portfolio, once it starts getting a little bit large, I like to diversify and move to other areas of the market. And then especially if it breaks below some key levels. So what I would, once the chart comes up, we can talk about the key levels. But one of the things I did want to talk about is the conversation we just had on precious metals and fiat currencies. So from our perspective, gold continues to remain in play. The gold stocks as a group continue to broadly lead. And so you can see this here. So what I would do is I would let the initial position continue to run. So I don't mind trimming a little bit here and there and then allocating it to other areas of the market. And that's, I think, part of what holding a good balanced portfolio means is that you trim a little bit. You want to keep the bulk of your portfolio, but you want to reduce a little bit of exposure and diversify it to other areas of the market. And that's where you could allocate it to, for instance, rare earth metals or some of the other areas or oil or energy that you aren't as well diversified into. So I would keep the bulk of the portfolio, but as the position continues to grow, I would look to trim a little bit along the way.
Okay, that was for Shondell. Let's go to Daniel in Markham. He's got a question today. Hi, Daniel.
Hi, Marilla. Hi, Javed. My question is on Athabasca oil. Can I have your technical analysis on the chart where you can draw entry points for a buying opportunity? And also, Javed, best technical analyst on market call, and come more often. Thank you.
Thank you very much. Let's get to Athabasca Oil and have a look at that chart. I know you're bullish on oil this year especially, and he's looking for an entry point essentially for this one. So let's pull up that chart and see what we see for Athabasca Oil.
Perfect. Thanks for the kind words, Daniel. What I would highlight here is here's the resistance level around 8. We just broke above the recent highs in this consolidation zone. You can see it's pretty important technical support resistance zone around 7. So I like it here. I don't mind buying here at these levels. And if we can pull up a longer term chart, maybe over the last 3 to 5 years, I can give you the longer term technical profile here on Athabasca. I like it. If I recall correctly, I think we highlighted it as one of our best picks for 25. I think we highlighted it as one of our best picks. But you can see here, continues to push higher, positive long-term trend, especially if you look how crude has done in this choppy sideways consolidation, essentially. Or downtrend, depending how you look at it in the timing. So I think this is an awesome chart. And if and or when crude does actually pick up, that's going to be an additional tailwind for a lot of these names. So I like it. I'd be a buyer here.
Okay, let's take a quick break. We will be back with more phone calls and your emails in just a moment. Welcome back. Let's go to Billy, who has an email. He says, what is your outlook on GFL.to? GFL, of course, just announcing this week it's moving its headquarters out of Ontario and down to Florida, to Miami. We had the CEO on yesterday, but here's the chart for the TSX GFL. What do you see?
Yeah, so this is a 3-year chart. So it kind of shows you this bigger uptrend, and now we've broken it and are in this downtrend. What I would highlight here is maybe we can pull up an even longer term chart, so 5 or 6 years. This is essentially the same business as Waste Connections. And so it's the same theme where we are in a cyclical risk-on environment. These are more defensive areas of the market. So I still like this longer term. It's a positive longer term chart. So I think there's going to be some consolidation here. I like an entry point around these levels because I think you'll see some stabilization. There is some pretty decent support close to where we are, call it around the 60 level. So ultimately, we like industrials, but this is the more risk-off industrials. So I think they'll continue to be kind of in this sideways trading range for most of this year. But as we head into 2027, that's when we get back into that more defensive risk-off environment. And that's where these names should shine as portfolio managers begin to rotate back into them. So I don't mind adding here while they're on sale.
Okay. Let's move to our next caller then, another Bill, who is on the line in Bowmanville, Ontario. Hi, Bill.
Thank you for taking my call. I'd like your guest's opinion on Constellation software, and maybe, as one other caller asked, when to sell.
Okay.
Thank you.
Thank you for the question. Yeah, Constellation's been knocked down a lot and hasn't really gotten back up. This is the 3-year chart. What do you think?
Yeah, so if we can pull out maybe a 5-year chart, and the reason I want to show viewers the longer term trend. So I think the first level we had here was 2750. Thanks so much for getting that chart up. Here's the longer term trend. We talked about this, I think, to clients around here somewhere, just highlighting that a bigger breakdown looked to be taking hold. I just got a question from one of our sales guys, JP, about support here on Constellation. That's around 2750. The thing is, if we take that out, which we are trading right below, then this next support level off, I think, is 2333.
Okay. That's very
just
specific.
it is because it's the number just stuck in my head.
Okay.
And I think I did this analysis for him a day or two ago. So that's where I think we're headed next. But the key takeaway is there's another 10% downside. So back to the question that you had, and maybe I know I'm taxing the back room, and we really appreciate their help. Maybe we can pull up a 10 or 15-year chart, and I just want to show people why technical analysis is such a great tool, because normally when the stock goes on sale, you're buying it cheaper, right? Mm-hmm. But when you get a bigger breakdown of a longer term trend, that's telling you something significant has changed. So here's this bigger, longer term uptrend. And then I kind of butchered that, but you get the general gist.
Yes.
And so this has broken this, and now it's heading lower. And so what a big advantage of technical analysis is its risk mitigation and risk control, right? Because from a fundamental perspective, it's dropped 30, 40%. So it's 30, 40% cheaper. But what's actually going on is there could be significant changes. And I think AI has affected a lot of these software companies. And so this is telling us something potentially significant could be going on. And so the next down big support here is around that 2,333 level. So I'd be trimming here. I think there's more downside coming, and then you could scale lower. So if it does bottom and if it does start to reverse up, then I would add back. But right now, it's telling us there's a bigger, significant shift that the market is seeing away from this name, and so it continues to put it under pressure. So I'm cautious. I think there's more downside. I think this is the next kind of defensive line in the sand. So technically, it's weak, so we'd be reducing here.
Okay, let's get to the next caller then. Chris is on the line. He's in Delta, BC. Hi, Chris.
Oh, good morning, Morella and Javed. Welcome back. Javed, I'm calling on Amgen. If I could please have your technical analysis of that stock. And if it's not something that really is appealing at this time, perhaps another name in the space. Thank you both, and have a great rest of your day.
Okay, thank you for the question. Let's pull up Amgen and have a look at the chart. They are a biotechnology company, essentially.
Yeah, so really like it, breaking out to new highs here, really like the setup. We've been talking to our U.S. sales team about biotech and healthcare in general. And if we're correct on our broader market call, then biotech should outperform some of the more defensive areas in healthcare into 2027. So at least into next year, I like the more offensive biotech over generic, more defensive healthcare. So I like it breaking out to new highs here. So the setup is positive. I'd be a buyer here. I think next upside resistance is around the 400 level. So it's positive. We like it.
Can you just expand on why you like the sector itself if people are looking around in the sector?
Yeah. So given our broader market call, we think that there's upside. You know what? Maybe we could pull up a 5-year chart of the S&P 500, and I can kind of walk people through it. It's a great question, and it really, I think, will help visually display some of our work for everyone watching this show.
Okay. What do you expect when you look at the 3-year for the S&P? What do you see?
Yeah, so
we'll pull it up in just a second for viewers.
Yeah, this is perfect. So this is exactly what I want to see. So at the start of 2022, we were warning clients that we thought a 4-year cycle reset, which is essentially the contraction phase of the business cycle, was going to take hold. Then in 2023, we told clients, look, we think a new 4-year cycle, and that's essentially a 3 to 5 year cyclical bull market, and then that new 4-year cycle had upside by time into the second half of 2025, first half of 2026. So then, lo and behold, we had this new bull cycle. And then at the start of 2025, we told clients, look, we think at some point this year, we are going to see that 4-year cycle reset, which is essentially the contraction phase of the business cycle. The reason it matters is that's when stocks really get hammered, call it down 15 to 20%. So we think April 8th marked a major low. And so we think equity markets are in a new 4-year cycle that should have upside by time into the second half of 2027, first half of 2028. So we're never going to get that timing call exactly right, but it gives us a great approximation. And then once we see warning signs flashing along the way, which we saw in 2025 and 2022, that's when we're going to warn clients and say, hey, look, we really think that something bigger is going to brew or show up as a big correction later this year. So I'll land the plane here, and what is happening right now, we're in this bull cycle that should have upside by time into 2027. Biotech is more risk on, it's more risky. And so this is where you want to have the tailwind of people taking risk with you. So that's why we like biotech here. However, if this was, if we fast forwarded a year and it was, call it mid-2027, then I'd be much more cautious, because then that 4-year cycle reset or the contraction phase of the business cycle is looming. And that's when people don't want to hold biotech. They want to hold like a Pfizer or something more defensive, where you're not going to see big returns, but it's boring,
Steady.
slow. And that's exactly it, Morella.
Okay.
Yeah.
Let's take a quick break then. We will have new picks from Javed when we come back. Join us tomorrow on Market Call. David Driscoll will be with us on the show. President, CEO, Liberty International Investment Management. He'll take your questions tomorrow on global stocks. And if you missed Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to new top picks from Javed. We're going to begin with CNQ, Canadian Natural Resources, on the TSX, which we were talking about is going sideways for most of last year.
Yeah.
But you're very bullish on oil and very bullish on Canada.
Yeah, so if we can pull up 5-year charts for these, I think it'll really help viewers see what we're seeing and why. So remember, we talked about where we are in the market cycle model. We think we're in phase 2, which we call the boring middle. And you can see here, it's had a bit of a corrective phase, and now it's starting to turn back up. But ultimately, what we think is happening is that we are going to see at the end of this year or early next year, and that's what we were talking about, where companies need to move their widgets around, and they need fuel, and that's going to fuel the demand, pun intended, for energy. And so as a result, we're bullish on CNQ. It's covered by our energy analyst out in Edmonton, Michael Barth. He likes it. I think he has it rated outperform. So fundamentally, we like it. And technically, I think it's setting up here for a move higher. And yeah, we're positive.
Okay, let's get to your next pick, which is West Fraser Timber, WFG on the TSX. It has 13 buys right now and 11 holds. Tell me what you like about West Fraser Timber being in a difficult position, of course, with tariffs on lumber for the U.S.
Exactly. So, and we had the question, we had Best Ideas dinner last night, and we faced the same question last night. And what I would highlight here is where we are in the market cycle model. So actually, I apologize for the back and forth. We can go out maybe 10 years, and I'll give you guys an idea, because I just want to flag we are in the boring middle of the market cycle model, and that's where the economy starts to strengthen. And so that was our view here, I want to say in 2017, but definitely in 2020 as well. So we highlighted lumber stocks in both of those areas because that's when the economy broadly starts to strengthen. We think rates are going to be sideways, essentially. That should remove a headwind for home builders and should make it more likely that we see a pickup in housing starts and in housing in general. That should be positive for some of these lumber stocks. Now, there are lumber stocks that have more torque, so we highlighted Interfor. Both of these names are covered by our lumber analyst out of Vancouver, Daryl Swetlashov. So I think he has an outperform on West Fraser as well. But the bottom line is, now ignore COVID, we look like an idiot, but then we looked pretty good after because everyone stayed home and built out their decks. Mm-hmm. But the bottom line is, this is the boring middle of a 4-year cycle. And so we believe that is coming as well. So these names have been beat up. No one's really interested in them. I like them. They're technically turning the corner. But the last point I would leave is, remember we talked about smart money positioning on crude? Mm-hmm. We're seeing the exact same thing in lumber. So smart money, and in crude and in gold, they're normally short, the commercial hedgers, because they want to hedge their production, and sometimes they hedge less, which is exactly what's going on in crude. But in lumber, they actually go long. They're long lumber here. Okay. So smart money is long lumber. I like it. They're the smart guys. I'm going to follow their lead. Okay, just want to make a correction. The analyst buy 13 was for CNQ, not for West Fraser, and hold was at 11. Okay, let's get to your last past pick, or your new pick, Pembina Pipeline, 3PL on the TSX. And again, under the same theme, you like Canada, you like the energy sector, and you're including the pipelines in that. Exactly. And so that's what we were talking about earlier with MPXL when we had a caller coming on. So here's kind of this consolidation phase. We're seeing another consolidation phase here. Looks like it wants to break out here. So I like buying it here. And remember, a lot of our work is, and what differentiates us from a lot of analysts is we have this roadmap. Like we know where, or at least we think we know where the puck is going. So we're not always going to be right, of course, but at least we have an idea of a roadmap, and then we have risk control levels along the way. So we would limit risk, for instance, here near these lows. So that's a pretty compelling setup because you've got a good reward risk ratio where you could limit risk here, but then your upside is a lot higher. So like the setup, and you get paid a dividend to wait. And if we're correct, Morella, in terms of where we're headed next year, then this stock, in our view, is poised to push higher out of this consolidation.
The support level is pretty much where it was trading today.
Yeah, well, maybe we could get a daily chart, and I could quickly highlight that support level that we're seeing. But you can see here, it's basically around this level. So,
which you would call, because we don't have the chart up, where would you say that is? There we go.
There we go, perfect. So I think I want to say first support here is, this is a daily chart. Maybe we could get like a 9-month daily. But the bottom line is, I think the message we're trying to communicate is that essentially we're close to support, so I don't mind buying here because the reward risk ratio is going to be compelling here at these levels.
Okay, Javed, got to leave it there. Thank you very much for coming in. Good to see you.
Thanks for having me.
And thank you for joining us today on Market Call. We'll see you back here tomorrow.